Yogi, and today I would be talking about how you can use the vertical call option if you are bearish or mildly bearish about a stock. So, just as a bookkeeping, what you can do is go to my channel on YouTube, youtube.com/c Gaur Associates, and click on playlists, and then you can click on options trading, and you can see all my videos on options trading that I will be adding over the next few months. Since this is a little bit of an advanced strategy, I would recommend reading about call option trading and also about the geeks itself. So that's it for the background. Let's get deeper into how this strategy works. So the main way this strategy works is that you have made an assumption that you are a little bit bearish about the Tesla stock. So if you look at the Tesla stock, it is trading at about 123 right now, and you are going to be making a bet or an assumption that it will stay below 125 by the time this option will expire. And we will choose the February 17th option or the third week of February option. So the way this strategy works is called a credit spread strategy, because I will explain why. It's a mildly bearish strategy because you are making a bet that Tesla would stay below 125. The advantages of this way to do it is you have a reduced premium to take on the position, and you usually get a credit for that first. It's a limited, well-defined risk for taking the position, and it is pretty much theta time decay neutral. As you know, options decay over time, or they lose their value over time. Since it's a pairing of two options, it is essentially theta time decay neutral. And I will also explain this a little when I show you how to make the trade. So what you do in this is you basically sell the call for 125. So it's a one short call, and at the same time you would be buying a 135 one long call. So in this particular example for February, for selling the one short call, you will be getting a premium of $9.93 per option, and that is a credit. And since you are selling a call for 613, that would be a debit. So your net premium credit you will get is 3.8. Since one option is equal to 100 shares, your profit will be $380. That's basically 3.8 times 100, 380. And this max profit occurs if the Tesla is less than 125 at expiration, because the both calls are going to expire worthless, and you get to keep the premium. So that's your best case situation. You get the max profit. A max loss would occur if Tesla is greater than 135 at expirations. So basically, what you do is the values of the two options is 135 minus 125 times 1000, and you got $380 for the premium. So you add that, and that's basically what you would lose, and this loss would be $620. Another way to think about this is that a max profit will occur, which is $380. Basically, you have a 125 short call, and the value of the Tesla is less than 125. Both calls are expiring worthless, so you get to keep whatever the premium was, and that was $380. And you can also see the break even is going to be a little bit higher than 125. It's actually calculated by the program to be 128.80, and that's a break even, or you make no profit or no loss. And then maximum loss would occur when you are the Tesla price is greater than 135. So let's see how you can make this trade. It's pretty straightforward. In most programs, what you can do is you can look at an option category called the vertical call, and in this case we want to sell lower and buy higher, because we are selling 125 and buying 135. So you can see sell to open 125, buy to open 135, and we'll take the midpoint range. And as you can see, the profit has already been calculated, or the max gain at expiration would be 380, and the max loss would be 620, which is what I actually showed you there. And in terms of how to explain the delta neutral, so what you can do is you can kind of look at the individual option as to how it does it. So here you can see that the theta on the 125 is minus 0.15 something, And on the 135, the theta is actually minus 1.14, and since one of them is a short call, so this becomes plus 0.14 minus 0.15, and that's almost negligible 0.01. So that's basically why this is essentially called a theta neutral position. It is actually vega neutral as well, because the volatility is in both of the options and it gets cancelled out to a great extent, so it is almost going to be close to zero as well. So that's the advantage of this. To make this trade is pretty straightforward. You just make the trade in Street Smart Edge, and to review, it says sell to open is 125, buy to open is 135. You have a small amount of commission, and your net credit would be $378.68. So I will not be making this trade. So that's pretty much all there is to it. So if you're a mildly bearish about a stock, you can make this strategy for vertical call credit spread work for you. If you have any questions, please add them in the YouTube channel and I'll try to answer them. And you have a great day. Bye.